October 19, 1987. In a single trading day, the market lost 22.6%. Not over a month. Not over a week. In hours. It's still the worst single day in stock market history. And here's the part nobody tells you. I've studied market crashes for 50 years. And Black Monday still stands alone. The Dow Jones fell 508 points in one session, a drop so violent it made 1929 look gentle by comparison. People genuinely thought it was the end. But what happened next? That's the lesson. Because the investors who panicked and the investors who stayed calm ended up in two completely different places. Picture the trading floor that morning. Phones ringing off the hook. Specialists who couldn't keep up. The sell orders just kept coming. By the closing bell, the Dow had fallen from 2,246 to 1,738. 508 points gone. And it wasn't just America. Hong Kong shut its market down entirely. London fell over 10%. Australia dropped more than 25% that week. This was the first truly global crash. But here's what's strange. There was no obvious reason for it. So what caused it? Not a war. Not a bank failure. The real culprit was something called portfolio insurance. It sounds safe, doesn't it? It wasn't. It was a computer strategy designed to automatically sell stocks as prices fell to limit losses. But think about what happens when everyone runs the same program. Prices drop, the machines sell, which drops prices more, which triggers more selling. A feedback loop. The market was eating itself. Mr. Market wasn't just emotional that day, he was on autopilot, and the autopilot was screaming sell. Now here's where it gets really interesting. If you only knew one fact about 1987, you'd assume it was a catastrophe year. It wasn't. Despite losing 22% in a single day, the Dow Jones actually finished the entire year up. A small gain, but a gain. Let that sink in. The worst day in history happened, and 12 months of stocks still ended green. The market clawed back its pre-crash highs within about 2 years. Federal Reserve Chairman Alan Greenspan, just weeks into the job, flooded the system with liquidity and made one promise: the Fed would provide support. Confidence slowly returned. This is the part that matters for you. Imagine two investors on that Monday. The first one panicked. Sold everything at the bottom. Locked in a 22% loss and sat in cash, too scared to return. The second one did nothing. Just held. Within 2 years, that second investor was whole again and then kept compounding for decades. As Buffett famously put it, the stock market is a device for transferring money from the impatient to the patient. Black Monday proved it in real time. The crash didn't destroy wealth. Panic did. The market was simply a voting machine having a very bad day, but in the long run, it's a weighing machine. Here's the one thing to remember. A crash is only permanent if you make it permanent. The market handed everyone a 22% loss on paper that Monday. But paper losses only become real the moment you sell. The investors who understood the difference between price and value didn't see a disaster. They saw a sale. And remember, this is educational content, not financial advice, and past recoveries never guarantee future ones. But history rhymes. Volatility is the price of admission for long-term returns. So let me ask you, if Black Monday happened tomorrow, what would you actually do? Would you sell, or would you hold? Tell me honestly in the comments. I read every one. And if this changed the way you think about market crashes, hit subscribe. We do this every single day. Tomorrow, we're breaking down a bubble that fooled some of the smartest people alive. You won't want to miss it.